Hi folks, Ryan Honeyman here from Lift Economy. Many folks have come to us over the last 10 years and asked, how do I get more involved in creating an economy that works for the benefit of all life? They also ask, what skills and experiences do I need to help make this transition? So 3 years ago, we created something called the Next Economy MBA to help address this and similar questions. Lift Economy's Next Economy MBA is an online course that's designed for entrepreneurs, aspiring entrepreneurs, students, recent graduates, employees, and folks who want to learn more about transformational next economy strategies and businesses. Join the growing alumni network of nearly 250 alumni who've gone through this program and learned essential skills and hopefully built lifelong relationships for catalyzing businesses in the emergent and regenerative economy. So we encourage you to check out our course. You can go to lifteconomy.com/MBA. The next course, Cohort 7, starts on September 21st, 2021. So once again, go to www.lifteconomy.com/MBA. And now, on with the show. Welcome to Next Economy Now. The goal of this podcast series is to highlight the leaders who are taking a regenerative, bioregional, equitable, democratic, racially just, and whole systems approach to creating the new economy. Laurie, welcome to the show.
Thank you, Ryan. It's a pleasure to be here.
Laurie, let's start off with a bit about your background. What were you doing before the whole impact space really developed, and how did you kind of get into this type of work?
Mm-hmm. I've been out in the workaday world for about 30 years, and so the first half of that was dominated by my work in the nonprofit sector as the CEO of national and international environmental sustainability organizations. Principally, a big chunk of that time was as the founding executive director of an organization called the Orion Society, which publishes Orion Magazine, which is a kind of like a Harper's or New Yorker quality publication focused on people, nature, place, and the various connections between those things. And that kind of led to me starting at some point in the early 2000s a nonprofit think tank and incubating agency or organization. And one of the projects that I incubated in that organization was the thing that ended up transitioning me into at that point, impact space that was just being birthed through the emergence of B corporations, certified B corporations, and impact investing out of the think tanks that had developed them.
Great. And yeah, you mentioned B Corps. How did you first get involved? How did you hear about B Corps? How did you I think your company was one of the founding B Corps, is that right?
Yeah, so I started this digital media initiative in this incubating nonprofit that I mentioned. I received grant monies from a Bay Area foundations to develop the idea, but very early on I started meeting people who straddled the philanthropic and the social enterprise world, who were saying, you've got a big idea here. You're going to need some serious resources to kind of do it properly. And there's likely a strong business model somewhere in this idea. Why don't you think about it not as a nonprofit organization, but as this brand new thing that's about to emerge from think tanks called the Certified B Corporation. And I also take a look at this other thing that's emerging pretty much at the same time called impact investing. And I started researching that and going to meetings of, say, Investor Circle and Social Venture Network, and I drank the Kool-Aid, and I really, having worked for as long as I had in the sustainability sector, and in that work, I worked with, had the great pleasure and honor to work with some of the leading thinkers in sustainability, whether it be like Bill McKibben on climate change issues, or Wendell Berry on agricultural issues and community development matters, or Jane Goodall or E.O. Wilson on biological diversity issues. All that work kind of gave me a pretty strong grounding in because of the whole range of sustainability challenges. But alongside that, I developed a really strong awareness that business, as it was being conducted throughout the world, particularly in developed economies, just had some fundamental flaws to them. And these are things that have been discussed by ecological economists and others for quite a long time. The excluding of natural measurements of natural services, ecosystem services from economic modeling and economic strategies, et cetera, et cetera. Anyway, it was a no-brainer for me to kind of reach the conclusion that we needed to change the paradigm of business dramatically to have a realistic chance of finding a sustainable path for humanity on this planet. And in what I was seeing in the development of the certified B corporations, and also in impact investing, at least in kind of the perspective and words of some of the more sophisticated advocates for impact investing early on, I started seeing the glimmerings of something rather profound and very rich in a transformative way emerging, and I wanted to be a part of it. And so, with the support of the foundation that had supported my early work on this project, I transitioned it into this new hybrid for-profit model, and it became one of the first B corporations, or a founding B corporation. So one of the first 20 or so companies, and I also, very much bought into this idea for this type of mission-driven, double, triple bottom line company, that you really needed to have very mission-aligned funding capital, helping to fuel it. And so, I started at the same time seeking out impact investors to fund this company, and indeed had some of the first, and in one case, the first ever impact investment under that name into the company through the first impact investing specific online exchange. So I was an early entrant into this space, and to this day am a huge advocate for both things like B corporations, as well as, of course, impact investing.
Yeah, a quick aside is you're one of the people who has the most mutual connections with me on LinkedIn. I think you have like 614 mutual. I was trying to find another one. I think Andy Fife from B Lab has 618 or something, so he's slightly, but it's funny.
I'm in a race with Andy. Okay,
that's right.
Got it.
But you're sort of involved in so many spaces, like you've or have worked in media, environment, social justice, place-based investing, entrepreneurship, social ventures, impact investing. What about right now? Like, what are you most excited about or energized by in the work you're doing today?
Yeah, well, broadly speaking, I'm just energized by the kind of, I don't think it's unfair to say the exponential rise of impact in the world, especially in the last couple of years. it was a kind of a very slow going, I would say, at least to my experience in the first few years in 2007, 2008, 2009, to kind of find enough like-minded people in the United States and around the world who kind of were starting to focus on these things like B corporations and impact investing, and that has rather dramatically changed, especially in the last few years. And indeed, the genesis for Impact Entrepreneur, which is a initiative I started in 2011, was very much designed to help that maturation process of the space along, initially through creating a global network of entrepreneurs, investors, scholars, and students who were really keen on this type of business and this kind of investing and the teaching of these things in academia, and then into consulting for a pretty wide range of early and growth stage companies, as well as academic institutions and impact investors. And then more recently, in the work that we're doing with the Impact Entrepreneur Center, all the educational and incubation programs that we've either launched or we're in the process of setting up and launching. But that all this work that I'm engaged in with Impact Entrepreneur has really kind of grown up with the space and was designed to grow up with the space. I reached the conclusion in these early years of 10, 11 years ago, that yes, there would be tipping points and thresholds that would be reached, but the healthiest perspective to take was a long-term one, that real change in the business landscape using these kinds of business structures and new business structures and investment instruments, that it was going to take time for them to catch hold, and for the kind of the truest or most authentic parts of these initiatives to really become the dominant thing, the dominant ones. That was going to take time and a lot of work by a lot of different people in a lot of different places. So, and that's happening. I mean, we're making huge strides, but we still have quite a mountain to climb, and it's just that the numbers of people who are working to push that rather sizable boulder up the very steep hill have really grown in numbers, and there's a lot of energy there being put behind that effort.
One of the things I've been struggling with, I think a lot of us in this space, and I'd be curious to hear your thoughts, but this idea of impact versus market rate returns, and can you have both, or are you, if you really do have market rate returns, are you really creating that high of impact? And I'm just really interested in, I think you probably have these conversations with investors and foundations, and I'm curious, one, if you think that the whole, like, we want to have our impact and market rate returns, is that a bit of a, we're sort of hoping that's true, but maybe it's not really true? Or I'm just kind of curious how do you think about that sort of impact versus market rate conundrum?
Well, I think it's a big mistake to make it an either or situation. Either you're getting your cake and eating it too, or you're not, and you're having to only work in a concessionary return way. I think that's a terribly simplistic way that people kind of approach these questions, and I find that the ones who usually vocalize it are usually the ones who are newer to the space and really haven't kind of delved deeply enough into the nuances of the space. The reality is that there's a very wide spectrum of approach and context to impact investing, and market rate or market beating returns are a part of that spectrum. Particularly if you look in areas like renewable energy with all the tax incentives and all the support there is to make this transition away from fossil fuels to renewable energy as quickly as possible. There's just a lot of ways to make a lot of money doing good in the world. So, but at the same time, there's just this very wide spectrum of projects, of companies that are building have in their DNA, really serious social and environmental goals and products and services that they're offering, and that there's a wide range of just how profitable they're going to be. It gets further complicated by the continuum of these companies, the growth continuum of these companies, that in many cases, and I've worked with a wide range of early stage companies, from renewable energy to sustainable food and ag, sustainable clothing and fibers, microfinance, waste stream technology companies. I mean, you name it, I see it coming through the Impact Entrepreneur Network. But one of the archetypes of a impact company that I see out there is that often there is a longer timeline to maturation, to profitability, to scaling up, in part because these companies often are being very disruptive on more than one level. They may have a product that is just so brand new that there's the time to establish that product and create a customer base. It takes its time. There's often a really heavy educational component to an impact company, alongside just the sheer production of a good or service. Education into the community of customers and stakeholders. So what all this kind of means in terms of impact investing and the spectrum of return expectations is that really what we need is to look at impact companies often very differently than the traditional companies. And so what we're doing at Impact Entrepreneur Center, and alongside others who are deep into this in the space, such as like Mission Investors Exchange and RSF Finance, and a number of others, we're looking at new and better ways to invest in these companies. And this is all, or much of it is taking the form or coming under the rubric of integrated finance, integrated impact finance. So that's something that I'm very interested in, and we've recently released a report with Rockefeller Philanthropy Advisors focused on, among other things, integrated finance. And I'd be happy to talk more about that because there's a lot to say.
Yeah, and that's just so folks are clear, is that sort of blending philanthropic plus, maybe concessionary or grants with an equity. Yeah, maybe you could speak a little bit more about that sort of approach you're talking about.
Yeah. I think it's worth differentiating between blended finance and integrated finance. The way I think most others kind of would differentiate the two would be blended finance has been around for quite a long time. That's usually using kind of government programs, government funding that in such a ways where it will leverage private capital down the road. Integrated finance, as you just suggested, is really a bringing together under the same umbrella philanthropic funding whether that be grants or increasingly program-related investments, low interest loans that come out of their 5% granting program granting that they do, or mission-related investments that are investments made out of their kind of their full asset base, the other 95% of assets. So philanthropic funding, as well as private capital, whether that be concessionary, be done through concessionary rate loans or market rate loans, safes, and then of course private equity. It is my personal opinion, having worked with quite a few impact companies, where the question of investor alignment is so crucial, that in many cases, the jump immediately to private equity or selling equity stakes in your company to fund your growth comes way too early. And so the integrated finance new continuum that we're working on is putting forth a graduated a ladder of funding for companies that is much more attuned to the particular needs and kind of current realities of growing impact companies. So in other words, avoiding putting expectations on the amount that a growing company can return to investors before it actually has enough cash flow to do that without compromising the stability of the company. And so the use of, for example, philanthropic monies run through donor advised funds into early stage impact companies, that is one of the more important and I think exciting trends in the space. Many foundations and many philanthropists don't know that they can actually fund a quote unquote for-profit company, a social enterprise. They can. And donor advised funds are well set up to do that. It has to be done carefully, but it's being done with increasing regularity, and a donor advised fund like Impact Assets, which is the largest impact specific donor advised fund in the space, at least to my knowledge, they've been doing this for quite a long time and have a lot of experience around it. So, so integrated finance ultimately is being designed to be much more sensitive to the needs and often kind of the realities, i.e., this longer timeline for the company to develop than a traditional company. And there's still a lot more that can be done around this. There's more that can be done at the governmental level. And certainly there's a steep educational curve to get the $1 trillion of philanthropic monies that is sitting in private foundations just in the United States, aware that these new instruments and these new strategies are available to them, and to educate them or to bring them into the conversation about what we call impact economy building. And that's another thing that we could go into if you want.
I was just at the B Corp retreat recently in New Orleans, and they're talking about the B economy. So it's certified B Corps, all the legal benefit corporations, everyone who's taken the B impact assessment, the investors who are investing in B Corps, academia. But really quickly, before I lose a thread, you'd mentioned donor advised funds. And I do know some high net worth and other folks who have started those. What is why are donor advised funds better or different than some of the existing structures, and why is that important?
Well, it is maybe at this point in time, the easiest way for an individual to get money to a early stage impact company and get a tax deduction for doing that.
I see.
So that's therefore that funding can come out of their philanthropic monies and be an expression of their philanthropic strategy. So that is I think the most important role that donor advised funds are playing. For foundations, the donor advised fund kind of plays a oversight, offers an oversight role that the foundations may feel that they don't have the capacity to do themselves when you're talking about that segue into the for-profit again in quotes, because we're talking about the for-benefit space. But since there is that for-profit component to it that's core to it, it does it runs into 100 and some odd years of philanthropic practice and regulations around that, and a lot of that is antiquated, in my opinion, and I think in a lot of people's opinion. But the donor advised fund, by providing that intermediary where they can do the due diligence and oversight over the eventual recipient of the funds, it takes a lot of pressure off the foundation. So those are two reasons why DAFs are being used at this point with increasing frequency.
Got it. And if you could, are there maybe one or two challenges that, maybe this is more of a broad question, it could relate to impact investing in the flow of capital, but what are the top two challenges that keep you up at night in this space? It's like, if we could only do X, we would solve Y, or I don't know. Like, does anything come up for you with that question?
Well, sure. I mean, I probably could come up with 10 or 20 points, but I think the one that it's very close to the work that we do, because I feel it, and the people that I work regularly with around the world in the space who do similar work to what Impact Entrepreneur Center does feel this too, is that there is a deficit of funding for the ecosystem builders. So whether that be innovation hubs, impact innovation hubs, or the think tanks, incubators, accelerators. These are all these things, these parts of the ecosystem that are absolutely necessary for pushing forward with the thinking around impact investing and entrepreneurship and the impact economy building and the actual development of the businesses that are going to be populating it. It's very, very underfunded. And that was one of the big takeaways from our recent International Leadership Summit that we did and the report that we've just released. And that's accessible from our website.
Yeah. I'll have you kind of name the resources and website towards the end, but I love this thing you identified with the ecosystem. I'm not sure if you knew, but our company, Lift Economy, we raised $1 million, a little over $1 million, to invest in 10 women and people of color owned businesses around the United States. And we were determined to invest at least some of that money in the South and the Southern United States. And one of the things that came up was, there may be some entrepreneurs who are in the South. However, there's no ecosystem of support for those entrepreneurs. Like, I think we're pretty spoiled in the Bay Area and in places like New York or Seattle, where you have hundreds of individual angels and the impact hub, but that doesn't really exist in a lot of places. So I really wanted to resonate with your thoughts on the ecosystem being a big problem.
Yeah. In fact, just recently I've connected with a organization that works with 70 Southern colleges and universities, and we're getting into discussions around how our incubator program that we've recently designed to be done in colleges and universities as well as co-working hubs might be able to be piloted in some of this southern network of colleges and universities. So that's definitely kind of been on my radar recently, and part of my conversations with people around this question of how do we efficiently build the ecosystem.
Yeah, and it maybe dovetail with the Democracy Collaborative work around anchor institutions, and like having a giant university or a hospital in a place is a great source of potential local sourcing, but at most they outsource it to large multinationals. So yeah, that's really interesting.
In the report that we've released with Rockefeller Philanthropy, it's called Philanthropy Transforming Finance, Building an Impact Economy. And there's a kind of the 4 dozen or so senior figures who came together for the leadership summit that this report is a report of, came out with a call to action, a manifesto, or a challenge to mainly, particularly philanthropic institutions, foundations, as well as philanthropists. And one of the key parts of that challenge was to urge them to spend at least 1% of all assets on ecosystem building funding. And if you think about $1 trillion in just the United States and philanthropic foundations, 1% would certainly make an impact in helping to build the economy. I think there are those who think that figure should be quite a bit higher than 1%, but it's a good starting point, 1% of assets.
And so, who are some of the cutting edge foundations or philanthropists or impact investors that you think are really building out or looking at that ecosystem or really leading in that space that folks might want to learn about?
Yeah, well, definitely a few come to mind. The one group that I'm working very closely with right now, and that it's a initiative that Rockefeller Philanthropy Advisors is the kind of taking the lead on, but it includes Ford Foundation's Impact Investing Trust, Skoll Foundation, DRK, Draper Richards Kaplan Foundation, Porticus, which is an international, I think a UK-based or Europe-based philanthropy. And so they have an initiative called Scaling Solutions, and the ecosystem building element in that is pretty central. There are very very few who are ecosystem focused. There's with the emergence of place-based impact investing, which is another thing I love to talk about alongside place-based education, which is something I've been involved with for several decades. With the emergence of place-based impact investing and kind of thinking about regional impact, what I would call impact economy development, we're seeing the kind of the ecosystem-minded funder emerging, because in order to act, in a regional economic development way that has impact at its core, it just inevitably leads one to think about what the infrastructure, those key parts of the ecosystem that will help bring this alive. So for example, MacArthur Foundation and one or two other Chicago area foundations have committed quite a lot of money, at least $100 million, to something called Benefit Chicago, which is largely designed to inspire the birth of for-benefit businesses in the Chicago area. Boston Impact Initiative is one I love to kind of talk about and celebrate, because they really are authentically doing a cutting edge work around integrated finance and place-based impact investing in underserved neighborhoods in the Boston area.
That's Deborah Freeze, right?
Yes, exactly, Deborah. She's fantastic. She was at our leadership summit in July and is a very articulate advocate for a lot of this stuff, and more so than kind of a vocal advocate, she is doing it. She and her colleagues, Greg Watson and others there at Boston Impact Initiative, are just digging in and using integrated finance and experimenting in really fantastic ways, and really legitimately helping those communities. So that's all very promising. I think another thing we could discuss if we have the time would be opportunity zones. I think that the opportunity zone legislation and the opportunity that opportunity zones are offering to underserved communities around the country is a potentially revolutionary breakthrough for impact investing. It has some potential pitfalls or the concerns about misuse of the opportunity zones that are being vocalized by different people, and so there's some concerns around that. But that is a promising new instrument that we have, that's come from the federal level, and it could, it will likely be a key part of building out ecosystems, impact ecosystems locally in quite a few places around the country.
Yeah, I mean, we've got a couple more minutes. Do you want to speak a little bit more about what the opportunity zones are and why they're important?
Sure. So this was something, rather shockingly, this was a piece of legislation that was completely bipartisan, voted on and included in the very not bipartisan tax bill that was passed last year. But both left and right embraced the opportunity zone legislation. So that says something in and of itself. What opportunity zone legislation does is it allowed states to identify, based on scientific data around that marked out communities that are economically poor communities and underserved communities in different parts of the country. It allowed states to identify a certain number of those areas, and that was done earlier this year by all the states. So the actual opportunity zones have been decided on now, and there's, if you Google opportunity zone map, you can find out which areas are designated opportunity zones. What the legislation allows for is that if you, a person or an institution, organization, have any kind of capital gains from past investments, you can, instead of paying when you sell those investments, instead of having to pay the tax that you owe on the capital gains from that investment, if you turn that around and put them into an opportunity fund, which invests in businesses, kind of nascent businesses as well as existing businesses within a specific opportunity zone, that the tax that you're due to pay on that capital gains is deferred. And if you keep that investment in the fund for 10 or more years, you get a 15% discount on the tax that you pay. But the big kicker is that the new investment that you've made into the opportunity zone, if those investments are successful and make money, all capital gains, all those new capital gains from the new investment are entirely tax-free. So this is a massive, there's a massive tax benefit here for investors, and therefore a huge incentive to do something that savvy investors have been wary of for forever, which is investing in communities that don't have a strong infrastructure, a business infrastructure, and are underserved. It is such an attractive thing that at recent impact investing conferences I've been at, opportunity zone investment is definitely emerging as a big topic. At the last one I went to, a multi-billion-dollar fund announced that they had recently committed 25% of all their assets to opportunity zone investing. They felt so strongly about the advantages of this new this new tax incentive that's been created. So that's a little bit about opportunity zone. I think we're seeing early on, maybe not unpredictably, is that a lot of the early opportunity fund and opportunity zone investing is happening in the real estate section to develop real estate in opportunity zones. And I think that there's many people who are involved in these opportunity zones and local governments and elsewhere. We're very excited to see the influx of capital to develop rundown areas. There is concern that there's a gentrification process that could inevitably arise by improving buildings so much that the rents that will need to be charged for the upgraded places will price out the current inhabitants of those places, which are, quite reasonably the people you're trying to help. So that's one example of a concern that needs addressing and will have to be addressed as opportunity zone development really kicks into gear, which I think we're going to see happening very quickly because there are timelines to the legislation that could suggest that the sooner one gets involved in placing opportunity zone, those opportunity funds into communities sooner than later is important. So I think you're going to see a big influx in the next 12 to 24 months.
That's fascinating. I had no idea that there was any bipartisan stuff in that tax bill. So that's interesting.
Right, I know.
Well, we are out of time. So why don't you tell folks maybe if there's any resources you can point to, maybe on opportunity zones, and also where can folks learn more about you and your work, like website, or get in touch with you if needed?
Sure. Well, impactalchemist.com is our website, so you can pretty much see the scope of our work and also join the Impact Entrepreneur Network through there. I urge people on LinkedIn to join the Impact Entrepreneur Group on LinkedIn. As I mentioned, we recently released a report with Rockefeller Philanthropy on some of the things we've spoken about, and you can request that report from our website. You can also learn about our webinar series that we've just launched. We actually have our first webinar coming up in a couple of weeks with Impact Investing's one of its great luminaries, Jed Emerson, to launch that series. So I'd urge people to join our email list so that they can be updated on the different webinars and other workshops and programming that we're in the process of really ramping up right now. Opportunity zone investing, just there's a number of really good resources out there that have been compiled both by the government as well as organizations and investors in the space. I'd urge you to do opportunity zone map in Google to kind of get a lay of the land, and then go from there.
Great. Well, thank you so much for joining, Laurie. It's great to finally meet you, especially since we know 614 people on LinkedIn together.
Absolutely.
Yeah, but I encourage folks to check out your website and keep up the great work you're doing in the impact space.
Thank you, Ryan. It's been a pleasure.
That concludes this episode of Next Economy Now, and now on to our mini interview with Doug Bistry, CEO of Clearinghouse CDFI.
Okay, welcome, Doug, to this interview series, the Next Economy Now podcast. And for listeners, I think one of the reasons I'm excited about Clearinghouse CDFI is that you're a lot different than other financial institutions. And if I'm a listener and thinking, well, how do they make these loans if they're not taking consumer deposits? Can people get involved through investing in the bank, or how do you sort of get more capital to make these types of loans?
Yeah, well, and once again, we're not really a bank. We are a CDFI, and we have to really make an important distinction between that. But we're a lender, and certainly corporations can support us. And if there were high net worth individuals that liked our mission, wanted to make an equity investment in our corporation, we could certainly do that. They'd have to be accredited investors. But so for us, we are unique, and we haven't talked about this yet, but when I started Clearinghouse CDFI, we incorporated as a for-profit CDFI. And there are really only, I think, 4 of us in the country of over, I think, 1,500 CDFIs. And so for us, we raise both equity and debt capital. And right now we're big enough where we have a lot of resources for debt capital. But in order to grow and in order to continue doing the work we're doing, we do need equity capital. And so, yes, if there were listeners out there that were accredited and were interested in supporting the work that we're doing throughout our service area or in Indian country, we would certainly find a way to get them involved and to offer them equity. And I might add that our equity has performed quite well. We are profitable, and we've been profitable for the last consecutive 18 years. We're very proud to say that.
Yeah, it's not something that I would normally think of, if I'm an accredited investor, I could invest in Clearinghouse CDFI. So I think it's a pretty cool opportunity, I think.
Yeah, it is. And we could certainly use it. One of the challenges with growing CDFI is always keeping pace, having our equity keep pace with our debt capital. And, we've been growing since the year that we incorporated in 1996. And it's extremely important to us. And having access to that equity capital really helps us tremendously in terms of growing.
And it may be the thing you just mentioned, but is there any requests that you have for listeners to how they can help you grow this next economy?
Well, I know you have a lot of listeners that are, socially responsible and in the world of foundations and things. We've had, with one exception, we've had a hard time, cracking into foundations. And I think it really harkens back to what we talked about earlier. And the fact is that we are a for-profit CDFI. And it would seem to me that foundation we're not looking for a grant from a foundation, but a foundation could make an equity investment in our company. We could provide a good return, starting at 8%, maybe going up as high as 15 or 18% over a 5-year period. And so to that extent, we would love to talk to, big investors that have the ability to invest large amounts of equity. We are attempting to raise $75 million in this recapitalization. So it's a lot of money, but it will really fuel our growth for the next basically 7 to 10 years. So I think, foundations, other SRI type of investors. And again, if there are individuals out there and they are interested in this, we'd be happy to talk to them. We do have a place for them to participate, although we really haven't, done that a lot in the past. We have really worked mostly with the banks, and certainly with banks continuing to address CRA. Look, I think I'm the kind of guy that if somebody wants to help us, I'd love to talk to you, and we'll see what we can do. And we'll probably find a way for anyone out there who's listening that really wants to get involved with Clearinghouse CDFI to get involved.
Wow, 8 to 18% or 15%. That's incredible. I think there's probably also some wealth managers who sort of have a portfolio of high net worth folks who'd be interested in speaking.
We would love to talk to those people.
And where can folks learn more about Clearinghouse? And say if there's any investors who are interested, what's the best way for them to get in contact?
We have a great website that has a ton of information, including our financials. It is www.ccdfi.com. Again, that's ccdfi.com. And a lot of information there. There's contact numbers. I'd be happy to talk to anybody that is serious about investing or working with us. And also, we're looking for projects to lend, good projects. And so in our service areas, California, Arizona, Nevada, New Mexico, and all of Indian country throughout the United States. So if anyone is aware of an unmet credit need that has good community impact, or, often our loans are made to entrepreneurs, people of color, or members of groups that have been disenfranchised. And if anyone is aware of loans, boy, we'd love to hear from them as well.
Next Economy Now is a production of Lift Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.